Okay, we are recording. Hi, everyone. Good morning. I am doing this recorded lecture to go over a problem where we get practice, valuing material inventory and then, cost of material used and then material ending inventory using Fifo, Lifo, and the weighted average method. So in class, we got to do a Fifo one, and we got almost all the way through, I think, the Lifo one. Maybe we got all the way through, I can't remember, but we did not get practice with the weighted average method. So I want to do a problem out of our textbook that we do all three of them. And so this is problem 2-5 on page 120. And I am going to share my screen with you. So I already have it in an Excel file. So I'm going to share my screen with you and get that Excel file pulled up here. Okay, so, and I'll post this Excel file into Owlnet when I post the recorded lecture. So anyway, okay, problem 2-5 is on page 120. This one says inventory costing method. So the purchases and issues of rubber gaskets as shown in the records of Hillsdale Corp for November follow. And so I did already copy these down into the spreadsheet for us. So you can see those there. And that's what it gives us in the book. And it says complete a materials ledger account similar to figure 2-10. That's what we see here in front of us, right? The materials ledger account. For all three methods, FIFO, LIFO, weighted average. And so, yeah, that's what we're going to get practice with. It has a couple other questions here that we'll talk about once we fill this out. So, okay. So we're doing FIFO first. That is 1-A, and I guess I could type that in here, FIFO. So first in, first out. So the materials to be purchased first are going to be the first that we use, right? All right, so November 1, beginning inventory. So beginning inventory, we have 30,000 units. What in the world did it just do? Hold on. It's very strange. Okay, well. Always these little funky things get into it, and then it's like, what's going on? And of course, they don't just have the color that would match it all. Oh. And then to make this not look so funky, we'll add all the borders. Wonder if it's going to do that on every one of these. Anyway, we have 30,000 units at $3 each. And so our inventory, 30,000 units times $3 each. 90,000 at that point. Okay. And so what I'm going to do is format these cells real quick. So it gives us like the dollar signs and parentheses. Okay, so format cells. Okay, so we got the units. And then the price and amount, I want to put a dollar sign on them. Sorry, I don't think of these things until I'm in the middle of the problem. Okay, currency, 2 decimal places, $sign. Perfect. Except, I want this one. Okay, so beginning inventory, 30,000 units at $3 a unit. Okay, so we just did this one. And so the next one, November 4th, received 10,000 units at $3.10 each. Okay, so this is our received. This is our issued. Not sure what happened to those titles there. Okay, so received November 4th, 10,000 units at $3.10 each equals 10,000 times $3.10, 31,000. So then at that point, we'd have what? We'd have 30,000 units that cost us $3 each. And then we'd have 10,000 units that cost us $3.10 each. All right. So beginning inventory, and I'm just going to separate each one of these days by thick line, so we know. Okay. So at this point, and let me insert because I like doing this the other day because I think it helps. So at this point, after November 4th, right, we've got 40,000 units at 40,000 units at total cost of, what's that, 121,000? Where else can I put this where it's not in my way? Okay, so we've done this one, and then we've done the next one, November 4th. Okay. So 40,000 units, right? We had the 30 that we began with, then we just received another 10. So 40,000 units at a total cost of 121,000, right? And so at this point, and again, I like doing this because this is going to help us when we get to the weighted average method. So at this point, this would be a weighted average. We would take 121,000 divided by 40,000 units, which would equal, where's my calculator? 121,000 divided by 40,000, 3.025 per unit is what the weighted average would be at this point. Again, to get the weighted average, we're just taking the total cost of units available, for sale divided by the total number of units. So total cost of units divided by the total number of units. And actually, I will just put a $sign here to differentiate between cost and the number of units. Okay, the next one, November the 5th, issued 30,000 units. Okay, so on November the 5th, we issue 30,000 units. They're all going to come from here. right? They're all going to come from here. That was our beginning inventory. We're issuing 30,000 units, first in, first out. So the units we had first are going to be the first that we use, right? So now we issue 30,000 units that cost us $3 each. So we issued 90,000 worth of units. And our balance, our remaining balance, 10,000 units that cost, what are 3 zeros, right? 10,000 units that cost $3.10 each. So equals 10,000 units times $3.10, 31,000. Okay. At that point, and generally we calculate this weighted average after every purchase. So that would be like after the units received. But obviously at this point, there's really no weighted average to calculate because all 10,000 units cost the same dollar amount. So we're not getting we're not calculating a weighted average of the costs, if that hopefully makes sense to you. Okay, the next one, November the 8th. Okay, so we did this one. So the next one, November the 8th, receive 50,000 units at $3.30 each. Okay, so 50,000 units, $3.30 equals 50,000 times $3.30, 165,000. Okay. And then at that point, our balance, so we still have these 10,000 left. Now we just got another 50. So now we're at 10,000 that cost $3.10 each, 50,000 that cost $3.30 each. And again, if we were doing the weighted average method now, which we're gonna, we're getting there. We're gonna do that together. But now we've got what, a total of 60,000 units at total cost of, I got my calculator here. Let's see, so I don't mess it up. 31,000 plus 165,000. Total cost of 196,000. So then if we calculated the weighted average 196,000 divided by 60,000 units, if I can type here, would equal, okay, 196,000 divided by 60,000 units, 3.26. I mean, and really depending on how far they take this out. And I'm just trying to see here. So well, 3.26 is what it's coming up with. It's going to be that's just to really give you a general idea. And I guess actually, because what's going to happen is when we get to the weighted average method, where we valued these 10,000 units at $3.10 because that's what we paid for them. Under the weighted average method, they would have been a little bit less. They would have been $3.025 per unit. So the numbers are a little bit different. But anyway, that gives you an idea of how we calculate that weighted average and where we're going with that. So anyway, okay. November the 8th. So we already did November the 8th. Okay, so now we're on November the 15th, issued 20,000 units. So we've got 20,000 units. And so when we issue these 20,000 units, And really maybe the better way to write this, because we're going to use all 10 of these that cost $3.10 each. And then we're also going to take 10,000 from there that cost $3.30 each. So this would be 10,000 units that cost $3.10 each. What am I doing? And then 10,000 units that cost $3.30 each. Is what that would look like, okay? So we used all 10,000 of these, and then we took 10 from here. So our remaining balance, 40,000 units that cost $3.30 each. Is what we would look like after that November 15th transaction. Okay, our next one, November the 22nd. This one says we received 25,000 units at $3.50 each. Okay, so 25,000 units that cost $3.50 each. $87,500. Okay, so we had 40,000. Now we just received or basically purchased another 25, right? So now ending inventory, 40,000 units that cost $3.30 each, 25,000 units that cost $3.50 each is what we would have there. All right. And then our last one, November 28th issued 30,000 units. Okay. So 30,000 units, they're all going to come from this 40,000. So we're going to issue those 30,000 units all from that 40,000 that cost us $3.30 each. And then what's going to be left over is we're going to have 10,000 that cost us $3.30 each. And then we're going to still have all 25,000 that cost us $3.50 each. Okay. So we have that filled out. And now part of this is asking us, if we scroll down a little bit on here, it's asking us, and you know, I guess we could fill them all in first and then kind of fill this in. But remember, it's asking us for each method, FIFO, Lifo, and then weighted average, or they're calling it moving average on here. But cost transferred to work in process. So remember, those are the costs that are issued to work in process, right? Costs that are issued or transferred to work in process. So if we go back here and we highlight over these, we see that the cost issued to work in process, 253,000, and here we can do it this way and put the formula in here so we know where we're getting that. So equals 90 plus 31 plus 33 plus 99. So again, 253,000. And then the cost of our ending inventory, again, those are the units we have left. So we've got 10,000 units at $3.30 each plus 25,000 units at $3.50 each. Okay. So again, first in, first out, FIFO. The units that we purchase first are the units to be used in production first, essentially is what that means. First in, first out, right? Okay, so now 1B, this is LIFO, last in, first out. So we're going to see here now with LIFO, and I'm going to unhighlight these so that we can use them for LIFO now. Copy. We'll put them down here so we can look at them. Okay. All right, so LIFO, last in, first out. So the goods to be purchased most recently, or the materials that are purchased most recently, are going to be the first to be used now with LIFO, right? So what ends up happening are the older goods or the older units, the older materials are what ends up being in our ending inventory at the end of the period, at the end of the month, because we're going to continue to use the newer materials that we get, that we purchase, the newer materials that we get into inventory. So anyway, we'll see example of this now. So again, November 1, beginning inventory, 30,000 units at $3 each. And actually, the first two lines are the same with this LIFO as they were with FIFO. But anyway, we'll just type it in. It's not a big deal. So 30,000 units. Oh, man. What's it doing to me? I don't know how 30,000 turned into 2/18. Just not smart enough to know what the heck is going on there. Okay. Golly. Kind of makes this a pain in the butt. I wish I would have known it was going to get squirrely on me like that. Okay, and then quantity. And then unit price and amount will change to where it has dollar signs on it so we can make sure we differentiate between what is costs and number of units. And we do need decimal places. Yeah, okay. Okay, so that's our beginning inventory, 30,000 units, price of $3 each. So this is 30,000 times 3. 90,000. Okay. So that's what we look like after or with our November 1 beginning inventory, right? All right. So now November 4th received 10,000 units at $3.10 each. So now we have 30,000 that cost us $3 each. And we have 10,000 that cost us $3.10 each. All right. That's what we look like after receiving those units. Okay, November 5th issued 30,000 units. Okay, so this is where the first difference comes in. Remember with FIFO, when we issued these 30,000 units, they all came from here, right? They would have all come from that beginning balance because those 30,000 units were the materials that were in our inventory first. So those are the ones we're going to use first, right? But with LIFO, last in, first out, we're going to use these 10,000 first. right? So with Lifo, when we issue, and again, I'm not sure why it's not showing received and issued up here like it was, but anyway. So now when we issue these, we're going to issue all 10,000 at $3.10 each, and then 20,000 that from the $3 per unit inventory. So this is going to be 20,000 at $3 each. And then 10,000, $3.10 each. So again, this 30,000, November 5th, issued 30,000 units, because this is FIFO, first in, first out, which actually, you know, kind of, it makes me want to change it around actually. So 10,000 at $3.10 each, 20,000 at $3 each. We're going to use these 10,000 first, right? We're going to, you know, LIFO, last in, first out. These 10,000 were the last units to be purchased, or the most recent units to be purchased. So we're going to use those first. So then we're going to first use the 10,000 units, and then the remaining 20,000 will come from that beginning inventory. So what's left then, 10,000 units at $3 each. All right. November the 8th, received 50,000 units at $3.30 each. Okay, 50,000 units, $3.30 each. $165,000. Okay. So now our ending inventory, 10,000 units that cost $3 each, 50,000 units that cost $3.30 each. So again, now this next one, I think we're about to issue some units. The units that we issue aren't going to come from these older units like they would in FIFO, for example, right? They're not going to come from these older units. LIFO, last in, first out. The 50,000 were the last in, so they're going to be the first that we use. So November 15th issued 20,000 units. So again, 20,000 units are going to come from the 50, $3.30 each. So now we're going to have, what? We still got these 10,000 units at $3 each, but now we've only got 30,000 left of the $3.30 each. Ooh, okay. What do we have next? November the 22nd, received 25,000 units at $3.50 each. Okay, 25,000 units, $3.50 each equals $87,500. Okay, so now our ending inventory consists of 10,000 units that cost $3 each, 30,000 units that cost $3.30 each, 25,000 units that cost $3.50 each. Again, LIFO, last in, first out. Now, when we issue units again, we're going to take them all from here first, and then they'll come from there next, basically, right? These older goods, these 10,000 that were in our beginning inventory back here are still going to be, right? And that's what we're seeing here. So November 28th issued 30,000 units. Okay, so that 30,000 units, we're going to take all 25,000 of our most recent. equals 25,000 times 3.5. And then we're going to take the other 5,000 from the units that are $3.30 each. So we've got what? Ending inventory. We used all of these, and then we used 5 of those. So we've got 10,000 units left at $3 each. And we've got 25,000 units left at $3.30 each. Right? Those are our 35,000 units left in ending inventory. All right. So again, we go down here to cost transferred to work in process. If we say equals, go back up here. These are our goods transferred to, or units transferred to work in process. 261,000. And then cost of ending inventory. These two, which actually, instead of doing it that way, because I didn't even type in sum, I'll just say this plus this. 112,500. Okay, lastly, the weighted average, and I'll type in weighted / moving average. I kind of joked around, I remember, with a student last semester in intermediate accounting that, you know, depending on what accounting textbook you're looking at, you know, this is called weighted average, this is called moving average, this is called the average cost method, you know, a few different ways that they say it. But either way, we're calculating a weighted average. And to do that, we take total cost of goods available for sale, total cost of goods, total cost of goods available for sale or for use. I guess I should say in this case, because we're talking about materials, not finished goods, but total cost of goods available for use divided by, and I'll just put that divided by sign in the formula, divided by total number of units available for use equals weighted average cost per unit. Okay, that is that formula for weighted average method. Okay. So anyway, keep that in mind. We're going to keep that in mind. We're going to keep using that formula as we go through this together. So now we've got our transactions, and let me go back to them and pull them down here so we can read them at least somewhere. I want to be able to do our formula also. So maybe I'll put on like right here. Okay, so November 1, beginning inventory, 30,000 units at $3 each. So I have a feeling that this is gonna give me problems with the formats. So I'm gonna go ahead and just fix these real quick, like I had to do the previous two. So they all look good to us. So we want these two. Any decimals. there, okay. And then these guys. Change to currency so we get the dollar signs and the commas and decimal places. And this is actually, I know I posted the solutions manual. In the solutions manual, it's actually taking us out 5 decimal places, which is insane. It's going to make our numbers look so weird. But anyway, that's what it is. Okay, so November 1 beginning inventory balance 30,000 units at $3 each. So 30,000 times $3 each. Is what we would look like after November 1st. Again, that's the same with all 3 methods, right? We haven't really done any transactions yet. That's just our beginning inventory, right? All right, November 4th received 10,000 units at $3.10 each. So 10,000 units, $3.10 each. So 31,000. All right. So now that we have some units that cost $3 each, and we have some units that cost $3.10 each, we need to calculate the weighted average. So again, to get the weighted average, we're going to take 90,000, that's the total cost, and let me put dollar signs in here just so we're being absolutely clear. 90,000 plus 31,000, right? That's the total cost of the 10,000 units. So that's going to be our numerator, the total cost of goods available for sale. And then we're going to say divided by the total number of units available for sale, 40,000 units. And that's going to equal, so 121,000 divided by 40,000 units, 3.025. That looks very strange to me. Okay, that looks better. I don't think I messed anything up stretching that. Okay. All right. So that's our first weighted average calculation. 3.25. So our ending inventory, 40,000 units at 3.025 weighted average cost per unit. So 121,000. Obviously, that's the numbers we just calculated, right? Okay. So that's what we look like after the 4th. So now the 5th, issued 30,000 units, okay? So we're issuing 30,000 units. We've calculated a weighted average of 3.025 per unit. So we've issued $90,750 worth of goods or materials. So we had 40, we just used 30. Now we're down to 10,000 units. That cost 3.025 per unit. That weighted average per unit. So now we're down to inventory 30,250. Okay. November the 8th, Received, okay, so now since we're receiving more units, now we're going to have to calculate another weighted average cost per unit, right? Okay, so we've got 50,000 units at $3 and, oh, hot dog, $3.30 each equals 50,000 times $3.30. And so again, now we have to calculate another, and so I'm going to copy this and just put in the new stuff. For right here, right? Okay, so now we've got 10,000 units at $3, 3.025 per unit. So that's a total cost of $30,250, right? And then we have these 50,000 units at $3.30 each. That's a total cost of $165,000. So now the numerator is 30,250 plus 165,000 divided by now 60,000 units, because that cost represents 60,000 units, right? So let's do the math on this. 30,250 plus 165,000 equals, so that equals 195,250 divided by 60,000 units. And so again, they're taking us out 5 decimal places on this particular problem. So we're going to 3.25417. It's actually 1666666, but you know, we're going to 5. They decided on 5 for some reason. So now we've got ending inventory 60,000 units that we've calculated a weighted average of 3.25417 equals 60,000 times 3.25417. So we'd be at 195,250 and 20 cents. All right. Technically, we would just round to 195,250, but I'm just going to go ahead and keep all the decimals in there since that's the way they're showing it to us in the solutions. All right, November 15th issued 20,000 units. Okay, so 20,000 units at weighted average cost per unit, 3.25417. What we look like after that. And again, we had 60,000, we just issued 20. So now we're down to 40,000 that cost 3.25417 per unit. Okay. November 22nd received 25,000 units at $350 each. So again, because we've got more incoming inventory, now we're going to calculate another weighted average cost per unit. I mentioned at the beginning of this that weighted average really gets, you know, a new weighted average gets calculated after every purchase of inventory or every purchase of material, right? So now this equals 250,000 times $3.50 each. Okay, so now our formula, and again, I'm just going to copy and plug the new data in here to make it easier for me. So now our formula, we've got 130,000 $166.80. Oh gosh, what's going on here? Okay, so we've got 130,000 166.80 plus what we just purchased, which is 87,500. Okay, so that's our numerator. We had 40,000 units. We purchased another 25. So now we're dividing it by 65,000 units. Okay, so let me calculate this. So we got 130,166.8 plus 87500 equals, okay. So we end up with a numerator 217,666.8 divided by 65,000 units. So now our weighted average 3.34872. Okay, so we purchased this 25,000 units. Now we're up to 65,000 units at our newly calculated weighted average 3.34872. Okay. Lastly, November 28th, we issue 30,000 units. So we issue 30,000 units at our weighted average 3.34872. And we're down to 35,000 units that cost us 3.34872. Okay. So weighted average is not bad, you know, just depending on how many purchases there are, we're calculating it multiple times. So anyway, equals cost of transferred to work in process equals plus, okay, that's our cost transferred to work in process. And then cost of ending inventory equals this. Okay. All right, so that took care of number one and number two. Again, number one was complete the material ledger account. We did that. Number two, for each method, prepare a schedule that shows the total cost of materials transferred to work in process, which is this. And then the cost of ending inventory, which is this. Number three says, and let me just make sure I am reading this correctly in the book here. Number three, if prices continue to increase, would you favor adopting the Fifo or Lifo method? Explain. So for number three, it says probably Lifo because it'll come closer to matching current costs with current revenues. When costs are rising, revenues are usually increasing. Therefore, the resulting gross profit under Lifo will reflect the company's product profitability more accurately. Number four, when prices continue to rise, what is the effect of FIFO versus LIFO on the inventory balance for materials reported in the balance sheet? So, you know, in this problem, we had prices that were rising, right? And we see with the inventory methods between FIFO and LIFO that FIFO has the higher ending inventory because it's the newer or newly purchased units that are in ending inventory. LIFO has the lower cost of ending inventory because it's the older goods. Your book says in a period of rising prices, the balance sheet inventory under either method will most likely be less than the current market prices. However, as shown by the problem, the lowest figure for ending inventory will be reported when LIFO is used. LIFO charges the higher material cost to cost of goods sold, whereas FIFO defers more of the higher cost to the inventory on hand, right? Because when prices are rising under FIFO, it's the goods with the highest price that are in ending inventory, and it's the opposite with LIFO. So, okay, anyway, hopefully that made some better sense, and you guys get a better idea out of FIFO, LIFO, the weighted average method. As we go through, I know some of you have already taken intermediate accounting. Some of you are in intermediate accounting this semester. This is another kind of accounting principle that is discussed in intermediate accounting as well. FIFO, LIFO, average cost method. So we will see this again. Anyway, I will get this recorded lecture posted. I think I already clicked save on this guy. Yeah. Stop sharing. Hi guys. All right. And I will get this posted, and I hope you guys have a wonderful weekend. I'll see you later. Bye-bye. Let me know if you have any questions.